these are not so good results. So this means you need to improve in second test. You also need to improve in third test, and there will be an aggregate in second semester. But this is a year course though. I just mean in second semester, meaning which maybe around September, there'll be an aggregate. So you guys have how many opportunities to do well? You have 3 opportunities now. So what will happen is I will allow all of you to write the acro. So if you happen to miss one assessment, for example, let's say there are 4 assessments per year, but only 3 will be considered for the DP. So if you happen to miss one assessment, you are still fine. You will be allowed to write an acro, but you cannot miss more than one assessment. All right. If it happens that you, for example, what I will do, I don't mind. I shouldn't be doing that, but I don't mind. It's fine. I will allow all of you to write 4 tests. Then I will take the top 3. So it means now you have an opportunity to improve in your second test, the same opportunity in third test and the fourth test. Tomorrow we are interviewing tutors, and I'm hoping to get the tutor for you guys as soon as possible. Out of the candidates that applied, if one of them is, of course, selected for this course, you will have a tutor going forward. These are good news because it means at least you'll have someone also. If you happen to not hear me in class, or perhaps you don't kind of understand the content, it's okay. We still have a tutor whom you can consult. All right. So guys, I just want to ask you, how does these results make you feel about the course in general? Just guys, let's just talk about the course in general. Hello guys, can you hear me?
It's scary. It makes me feel scared for the course.
Or for the course, yes. But are the results kind of different than other courses across? I understand you guys should be doing 4 courses, right? So are the results too different, or maybe in same, kind of in terms of average? Guys, let's talk now. Guys, you don't want to talk. It's very important to talk about
terms of average, with what the other lecturers have said, it seems as if the results are the same, because with the other modules, the average was almost like the same as this one.
this one is. All right. All right. So this means, guys, we just have to try a little bit, maybe perhaps in a way in which we do things, not only for text, but also for other modules. It's very important because we, of course, for us to graduate next year, we as much as we need this course, but we need others as well. Believe me, I am willing to assist you guys to go through the course. When you navigate through the course, I know a lot of you must be very, discouraged. I understand that based on first test, but believe me, these results, they don't define your potential. Your potential is far more than these results. They are not just a reflection of your potential. So I'm just encouraging you guys to, to just make sure that you still, of course, look at a more positive side, when it comes to taxation, but not only taxation, of course, and also other modules. All right, that's fine. About the test, all right, let's just go through then the slides for today. But just one thing. Last week, we discussed a little bit about how you guys would like me to kind of calm down, meaning try to slow down. Yes. I know, and some people, of course, even in the past have complained that sometimes I can be too much when it comes to the pace. I understand that it's one of my weakness. It's my area of improvement, and you've noted that as well. Yeah. So I just want to understand the approach, because last week then I said to you, then the approach we may have is we have a video, then in class we kind of just go through a summary of slides a little bit, then we try to attempt a question. But I left that to you guys to think about it if what happens. But do you have an answer now? Or perhaps do you still need some time to just go digest that? Guys, where's our class rep? The class rep now should be the one actually talking on this. In fact, anyone, guys, but I mean, in case there is silence, the class rep should be, All right, guys, that's fine then. Then in absentia,
Sorry.
then
Sorry, sir. I think the response was sent to a class rep to pass it to you, that we agreed for you to post the videos, and then we can go over through the videos. Then when it's the time for class, and then we can do questions.
questions, yes. All right, that's fine. But thanks very much for that. But I think we will be able then to do that next week, because I'm only, learning about that now. But we'll do that from next week. All right. Thanks very much, guys, for suggestion. Please feel free.
Sorry, sir.
Yes, okay.
The other issue was not about the pace only, but it was about the application as well of the theory, because like the surgeon, it's all about the theory. So maybe if we can have one or two examples that we put this theory into practice, like to have examples, just one case study or whatever, because I think is a contributing factor in terms of our results as well, because it was difficult for us to approach your style of assessment, of which we've never maybe had any practical session of the application of what you are trying to guide us. So it's very challenging exactly to go to the test without having any idea how to approach a question.
Yes. Okay, guys. Okay, no, that's fine. I think then that will give us the opportunity then, if in class we go through an example, it will give us an opportunity to cover that. I think, yes. And also hoping that tomorrow we do get the tutor during interviews. So it means it will be better then, because there will be a tutor. The tutor will actually go through the example with you guys. There will be me going through an example with you in class. You will also be able then to raise any queries you have related to the slides or the video. I think I'm also in support of this better approach, and I do think it will come with improvements. All right. Thanks very much, guys, for being involved. Remember, your inputs are very important. And do you know what I like the most about you this year? The difference is that you are coming with these, you're identifying the shortfalls, perhaps maybe the weaknesses, maybe, what do I say, of this course now, immediately after your first test, before it's the last test. I remember last year it was only after the fourth test. Now, when people didn't have DPs, now they were complaining. You see, they had the way in which they would have liked the course to have been delivered. But now at least we have the same approach, then we'll try to improve on that. You see, but I like that, guys. You take ownership of the course. It's all the course. It's our course. You know what I mean? We want to pass the course. I want the people to pass. You also want people to pass. So it's very important to be, see, not one-sided. All right. Thanks very much, guys, for that. Okay, then today, we'll just go through the slides as usual, but I will try, of course, my real pace, I'll try to be, to calm down, as much as I can. All right. All right, guys, thanks very much then for attending the session. First of all, then let's just go through the slides. What are we saying today? What are we doing today? Today, we're dealing with capital allowances, right? Okay. So capital allowances. So this is just the prescribed readings for you guys. So this is just a framework. So it's very important. Believe me, guys, I've seen students not actually being able to follow through the framework when they're answering, maybe when they are actually giving the solutions. You see, yes. So it helps you a lot to kind of think what comes first. It's all about the gross income. Then we've got the exemptions. Then we have the income. Then now we go to the deductions, taxable capital gains, assessed losses. Then we've got taxable income. It helps a real lot to just have that understanding. So just have that structure, in mind when you think about things. You don't have to get it right, I mean, all the time, but at least if you appreciate these steps, I mean, you have an opportunity to score big, I mean, in the test, right? So these are just the sections that will be covered. Guys, I encourage you to look at, the basics. But let me just ask this question. Do you think, because I think there might be some of you guys that have done this course far back, right? Do you think it will be a good approach if I upload the third year slides? Last year I was also lecturing third year. So I do have access to previous year slides for third year. And third year in taxation and actually taxation starts at third year in UKZN. So it means it's everything that you need, all the basics. Are you happy if I upload that online also? So that if you feel like there is a need, you kind of go back then before you come to the advanced level. Are you happy with that?
Yes, please do post them. It
All
will
right, I will
help.
do that.
Yes,
Yes,
please help.
yes, I'll do that because you see, for example, now all these topics, they're advanced levels. So meaning which you don't then have the opportunity to go to basics. All right. So I will do that, guys. I'll just go back and check on I think, on Learn last year, then try to upload per each section. For example, if we're doing capital allowances, then those basics, so that you're able to try to grab from the basics, then you improve. All right. So just today, but for the purpose of this class, then we just go through, I mean, these topics. So we'll cover then section 8.5, which is deemed a recoupment on termination of a lease. Then we go over to section 12, capital E, that's your asset for small business corporations. Your 20, capital B, those are the limitations for scraping allowances. Then we'll also go on to 23, capital C, your 12, capital B, then you see all the sections actually. But these sections, guys, I said to you, they're actually on advanced level. So the assumption is that you must be having the basics. But I understand not all of you are doing tax last year. So that's why I'm suggesting that perhaps we could have those slides. All right. All right, let's just deal with this situation then. So guys, you should know one thing then, just maybe kind of basics. When we deal with capital allowances, we're actually dealing with deductions that are related to capital in nature. So when you actually, the section 11A, which is a general deduction formula, actually talks to it talks to the expenditure and losses which are actually incurred during the year of assessment, but not of capital nature. That's very important. So it means therefore everything therefore that is of capital nature is actually taken into account in terms of the capital allowances. It is for that reason therefore we are entertaining this topic. So this deduction then in respect of assets used in farming or production of renewable energies. So in the basics, when you go through slides, the slides, you'll find out that they will talk about your movable assets, though that will be a section 11E. They will talk about your immovable assets, your section 12C. They will talk about section 13. They'll talk about all the sections. But of course, guys, as I said to you, for the purpose of this class, we'll just deal with these things at advanced level. But of course, you are expected to go back for you to understand the advanced. Okay. So in this lecture, then, perhaps in this slide, in terms of section 12, capital B, this section deals with deduction in respect of plant and machinery in the production of renewable energy. So if the business is involved in production of renewable energy, then this section will apply. So, but you don't have to worry, so you don't have to worry about the section 12 capital P. So guys, in the slide generally, you are like to find a lot of things related to psych. It doesn't matter, don't have to worry yourself. These are just professional bodies, and perhaps was then SACA have examined pronouncement. Sometimes they do come with what they deem necessary, perhaps maybe what they deem important to be studied within the curriculum, which is most likely the same when it comes to ACA as well. So you don't have to worry yourself. So this section then, your 12 capital B will allow a deduction for a plant and machinery which is used for a biodiesel or bioethanol. So then it also allows for deduction of plant and machinery used in generation of electricity from wind power, solar energy, hydro. So this section then talks to you, if you know in South Africa, for example, now we've got energy crisis. So a lot of people, perhaps companies, are actually encouraged to invest so much in energy. So this section then gives them, an allowance in that regard. Yes. So the section allows for a deduction then on any of the improvements in relation to deduction noted above, as well as also an improvement then on any foundational structure. Okay, so the foundation then is deemed to be part of the asset if the asset is mounted to the foundation. So if the asset is allowed, so that the foundation therefore is allowed. So what is this section then saying about that? This section allows that taxpayer 50% in year one, 30% in year two, and 20% in year for asset except for photovoltaic solar, which is not exceeding 1 megawatts, of which 100% that is allowed in that case. So the cost of the asset then in this case is always the lesser of the cost and arm's length. But one thing you will notice, guys, perhaps maybe you have noticed it before, is that when it comes to the costs, when it comes to the allowance, so guys, please mute yourselves. When it comes to the allowance, SARS will always refer to the lower of the two. But when it comes to the amount that must be included in gross income, SARS always says the higher of the two. So you should note then there is no section 12 is available if an asset has been let under an operating lease or previously brought into use by a company or previously disposed of a taxpayer, which was granted a section 12 capital E allowance. Your section 12 capital E refers to small business corporations. All right. So this just about then the deemed recoupment on termination of a lease. If there's a termination of lease, there is a deemed recoupment. So there's this just kind of, what can I say? It's a decision 3. You know what I mean? Yes. So about what needs to happen. Yes, so guys, you've got to ask yourself some questions. Have you conducted a lease as a lease in an agreement? Do you have a lease agreement? If the question is yes, then have you acquired the asset at the end of the lease? If your answer is no, then there are other implications. So if you say yes, then section 8.5, you see, where lease rentals applied in reduction of the purchase price. So this section happens when, let's say, for example, you are leasing an asset, but now eventually you want to buy the asset. But when you buy the asset, they're actually saying, no problem, look, what could happen is that the value in which you are buying the asset will decrease by the rentals that you've been paying before. This is where the section applies. So if your answer then is you say you have to recoup the lease rentals applied in reduction of the purchase price. What does recoup mean? Means you add them back to your taxable income. So then section 8.5 then be stated that was the asset purchased for no consideration. So there are two instances: the asset can be purchased less than a consideration, less than what it should be, or it could be at no consideration. So was the asset purchased for no consideration or inadequate consideration? So if the answer is yes, you have to recoup the difference. If then, when you ask a question of have you acquired the asset at the end of the lease, your answer is no, then section 8.5b capital A applies. We ask ourselves a question again: have you been allowed to use the asset for no consideration and nominal consideration in relation to the fair market value of the asset? Then if yes, you have to recoup also, as you are deemed to have acquired the asset for no consideration. All right. recoupment. So this section then, in terms of the recoupment then, in terms of this section then, oh, sorry about that. All right, so guys, about that. Then in terms of the recoupment, then your section 8.4 is an assumed, that's why I'm saying to you guys, it's very important then to have that, text 3 kind of knowledge, maybe basic text. So section 5 then states that if the lease is allowed to purchase the asset at the end of the lease and was allowed a deduction, the lease rentals on the acquisition price, then you need to recoup any rentals that are deducted from the purchase price of an asset. It's what we've just been talking about on that diagram. But you should remember that the amount is not included in income if it is taxed under paragraph I of the gross income definition. So, for example, at the end of the list, you can buy the asset for R1. So for 1 million, less than 2 years worth of rentals. So you'll have then to recoup those rentals. Then section 8.5b then deals with when an amount has been paid for the purchase of property, the difference between the fair market value and the amount is paid is deemed to be applied in reduction of the purchase price. So now there is a market value, however, you are paying less than that. But this asset, it was actually subject to lease, operating lease before. You'll have to recoup the difference limited to rentals deductions. We've got an example, guys. So we've got Mr. Rose. He actually imported electronic equipment from GH Ltd at an annual rental of 40,000 per annum for 3 years. After 3 years, he is given the option to acquire the asset for 20,000 rand when the market value is actually what? 150,000 rand. Now you can see there is a huge difference. You've got a fair market value, which is the value in which where a willing buyer and a willing seller in the market is willing to sell. That's a fair market value. However, you've got the consideration, he's just paying 20,000. So you will have them to recoup, which is limited to the lease rental deduction of 120 years. So guys, this is very important. Why am I saying this is important? Most especially this thing of the limitation, because these are the key things that markers look for. Sorry, the examiners look for. For example, now you could easily make a mistake, of recouping whole amount. You see, however, you can only recoup to this. Okay, limited, of course, to rental deductions. Then in section 8.5b capital A and 8.5b capital B, then your B capital A state that it actually applies to a situation where the lease hasn't actually acquired the asset at the end of the lease. If the lease at the end of the term is allowed to use the asset as he deems fit without the payment of any rentals or consideration or payment of a cost that is nominal in relation to the fair market value, then the lease is deemed to have acquired for no consideration. In this case, you are allowed to use the asset, you see, maybe at no value. Remember, guys, how could I, maybe let's just say the examiner, how could the examiner ask these questions? So one thing I would like you guys to think about, most especially after the first test, is that you should know in text, it's very easy for the examiner to say, give me the text implications. Done. So if the examiner says, give me text implications, you are expected to explain what could happen and also go on and also have calculations, because they just asked the implications, text implications. So sometimes the question may say calculate. Sometimes we just say text implications. So you need to know, then you need to explain yourself. Say, for example, now we had a question here whereby so and so has had this asset for this long. However, now they're saying, no, look, Meneer, how about you use the asset at no consideration? So the question just say, give us tax implications. You would still be expected to explain and also do some calculations to get the marks. Section 8.5b capital B provides detail of the fair market value of an asset, as well as when a consideration will be considered nominal in relation to what? To the fair market value. So your B, then capital B, fair market value, they say is equal to the cost to the lessor, less 20%, reducing balance method depreciation. So what is the cost to the lessor of the asset? And we'll reduce it over each year by what? By 20%. So your 5 capital B to state that if the annual rental consideration is less than on termination of the lease, then the consideration is nominal in relation to what? To the fair market value of the asset. That's very important. Okay. So let's just, this is just a recap now, just taking you back to the idea. Perhaps to basics, you will have your section 11E. So for example, you have interpretation note number 47. So is it apportioned? The question is yes. Your 12 capital C, is it apportioned? No, you don't apportion it. So recoupment, 8.4 and 11.0, you've got to recoup and scraping allowances. But the cost excludes skills and labor where asset is constructed. It makes reference to the value. But in this case, in this one, which is section 12C, it includes the skills and labor. Because your section 12C, 12 capital C relates to immovable assets, while your E relates to all the movable assets. So that's why then your foundation and everything, if you had to pay a person, that will be included, really in a value cost of the asset. Other allowances, building allowance. So then in undergrad, then they talk about your section 13, they end there, but now we go on now to talk about section 12, capital N. So this section deals in a situation where if a taxpayer holds a right of use or occupation of land or a building in terms of a public-private partnership and incurs expenditure to effect the improvement. So where there is a public-private partnership by there's government and also a private sector, then now you incur improvement and uses or occupies the land or building for the production of income, then the taxpayer must be considered the owner of such improvement for the purpose of section 11 capital D, 11 capital B, 11 capital D, 11 capital 12, 12I, 12S, 13, 13 piece, 13 tear, 13 quad, 13 queen, 13 sex, 36 and 8 schedule. So section 13 allowances, this is just a revision for you. So it just relate to, it's a percentage in fact. You see your 13.1 is for the owner of a new or unused building, purchased or erected using the process of what? Of manufacture. Then you use 5% on the cost of the building. But remember in this case, what happens? We go back in this case, section 12N, even though you are not the owner of the building, right? But if there is a private-public partnership, then you incur improvement, you are allowed a deduction. So yes, section 13 queen, on owner of a new building also, when you construct a commercial building based on what? On 5% of the cost of the building. But if it is acquired, you claim what? 55% of the what? Of the acquisition price. Meaning which your 5% will be 55%, will be 5% of the 55% of the acquisition price. But this question also, remember, section 13 queen. It refers only to the owner. But under section 12 capital N, even if you are not the owner, if there's a public-private partnership, you are allowed a deduction. Building allowance, that's a section 13.6 on residential buildings. So of a new or unused building, acquired or erected based on 5% of the cost of the building, so you should know, but there are requirements. So as a taxpayer, you must own 5% residential unit to get the allowance. It must be part of the trade. So if it's a low cost residential unit, now they talk about low cost. So the low cost, they say it's less than 300 for a self-standing unit and less than 350 for an apartment. You get an additional 5% of the cost of what? Of the building. But you should know that, of course, if you acquire now then it will also relate to what? 55% of that. So it will be 5% of the 55% of the acquisition price. Then you move on to your section 13.7. So about on low cost housing. So section 13.7, then they also say if it's less than 300 for a self-standing unit or less than 350 for an apartment, then to employees, then these homes are provided via interest-free loans to employees, and the employers may deduct 10% of outstanding what amount. Section 13 set deals with where they are low-cost housing and they are given to employees at what? At free interest loans. So the employer then will be allowed a deduction on the outstanding amount which is owed by what? By the employee. These deductions are actually given to employers because they are encouraged, to give their employees, of course, these benefits. Deferred recoupment. Now, what is deferred recoupment? Deferred means something you defer for the later period, right? So this makes the reference then to paragraph 65 of involuntary disposal and 66 investment in replacement assets. So you should know that paragraph 66 state that the asset must qualify for deduction first of all for you to defer the recoupment. The proceeds must equal or exceed the base cost. Then in that case, the expenditure on a replacement asset must equal to or exceed what? The disposal proceeds. The replacement asset then are movable asset, and the replacement asset is required within 12 months of disposable assets. Okay, let me give just a brief about this section. So this section refers to, in case now, guys, you want to defer the recoupment. We all know you need to include your recoupment immediately to your taxable income. You need to recoup it, but you can defer it. You are allowed to do that. It may be involuntary disposal, or it may be what? In reinvestment. So you are reinvesting. So if, for example, now there were 2 cars, now instead of me adding back, right? So I'm reinvesting the amount, I'm buying other 2 cars with an amount. So instead of me recouping now the investment, they are saying they may allow me for my recoupment to be deferred to extend that I am allowed an allowance to these cars. Let's make an example. Let's say my recoupment is 100,000, but I'm buying 2 cars for 100,000. So I can be able to defer to say, I would not include 100,000 immediately. However, whenever I'm getting an allowance, right, for the cars, I'm also going to include what? A recoupment, which will be net off. It's actually a relief to the taxpayer. Section 8.4 then provides that the recoupment will not be included in income for an asset which is subject to what? To paragraph 65 and 66 of the 8th schedule. So because there is this deferral, right, of paragraph 65 and 66 of 8th schedule, therefore the recoupment will not be included immediately. But your 8.4e capital A state that where more than one asset is acquired to replace an asset disposed of, the amount recouped must be apportioned. So now if there is one asset that the recoupment relates to, let's say 100,000. However, I'm buying 2 cars now, 50,000, 50,000. They're saying it's fine. I may then apportion, the recoupment now in going forward to the extent that it's actually equal to those cars. So section then 8E capital B state that where the asset is depreciable asset, a portion of deferred recoupment must be added to income in each tax year. This is just what I've just told you guys when you're actually allowed the deductions. And they even say in a ratio of current year deduction to total deductions available to the asset. Then your 8.4E capital C state that the replacement asset then has been disposed of any amount which has not been included in the income in terms of section must now be included in income. Now, in case now you dispose now immediately your replacement asset, then you must include now all your 8.4E, which was your deferred recoupment immediately in your income. Remember, the way the question may come in this case, we can have a very confused guy that actually have done this, have replaced assets, then you are allowed to give an advice, maybe to state the tax implications to him. Okay, section 8 then E capital D relates to where a person ceases to use a replacement asset contemplated in section 1, section 8 for E, and any amount which is apportioned then has not been included in income in terms of section section 8 for E. That amount must be recouped in that year of assessment. Let's say now you said, okay, I've got 100,000 recoupment, I'm not including it. I'm following paragraph 65 or 65. Then I'm going to defer my recoupment going forward. Now, all of a sudden, you cease to use the replacement asset. They say it's fine, no problem at all. Add it immediately now in your what? In your taxable income. Your section then 84E, capital E, then refers to where a person ceases to bring the replacement asset within the time frames of paragraph 65 or 6 of the H schedule, then you will not apply. The entire amount will be recouped under what? Section 84. You will just have to recoup the amount immediately. Then this takes us then to the next, section, which is section 12 capital E, which relates only to small business corporations. So this provides for allowances used by small business corporation, SPC, at 100% for new or unused manufacturing plant and machinery, and 50%, 30%, 20% allowances for other assets, which would of course qualify for section 11E. So section 11, so what does this mean? So it talks to your assets, to your manufacturing companies, but that are considered to be what should be the small business corporations. So the recognition then requirements are similar to your section 12E, 12C, and also assets must be brought into use for the first time after 1st April 2001. I don't think you might get a question that refers, to that far back, let's say, 31st March 2001, I don't think so. In this case, there is no apportionment. There is no apportionment at all, okay? All right, guys, all right? Please mute yourselves. Okay, let's carry on. Guys, please mute yourselves, please. Remember, this session is recorded. So limitations of scraping allowance. So your section 11O then, allowance is claimable by a taxpayer where he elects such a claim in respect of what? Qualifying depreciable assets, which has been lost, destroyed, or alienated during the year of assessment. Then your section 11O then is ordinarily computed as a difference between the cost of an asset after adjusting for tax allowances and the proceeds from alienation and of the asset. So, but you should know that then the moving costs must be added, of course, to the cost of the assets. Section 20, capital B, provides that your section 11O, which is allowance for scrapping allowance, will be disregarded of the full consideration of disposal if a disposal does not accrue to a person in the year of assessment. So there is that requirement that the disposal should accrue to a person. Then the disregarded then of this loss will be taken into account in the calculation of a taxpayer income in following year of assessment, provided that the consideration received from the disposal is included in taxpayers' income in the following year of assessment. Also, if there is any remaining disregarded section 11O, which is scrapping allowance, it will be deductible in full, provided the taxpayer can prove that no further consideration will accrue to him in respect of what? Of that asset. All right. Then we'll move on then to section 19. So it's quite a long section. This is just the summary of section 19. It deals with definitions. It deals with the applications for a debt benefit from a compromise. It deals with the debt benefit arising from a debt used to acquire trading stock. For a debt benefit that deals with the trading stock, which will be recouped. Debt also benefiting from expenditure, which will be recouped. You see, yes. But this is just a summary of the sections. I think let's just go straight to the section. Let's start with these definitions first. They talk about the concession or compromise. So the cancellation or waiver or remittance of what? Of debt. In this case is where the company is cancelling a debt. Say, for example, company A owes company B. Then company B is saying, we are cancelling a debt, or we are giving you a waiver or remittance to the debt. So when a debt is extinguished by a way of redemption of debt claim, by way of measure of reason of the acquisition of the debt claimed by the person owed to the debt. So in other case, also a debt owed by a company that is settled directly or indirectly by being converted to or exchanged for shares in that company by applying the proceeds from shares issued by that company. So company is saying you owe me you owe me 100,000. I will just buy shares for 100,000 from your company. Perhaps give me the shares. So in the case of a debt that is cancelled, waived or remitted, of course, the debt benefit will be the amount that is cancelled, waived or remitted. Because remember, there is a company that is having a debt benefit. There is a company that just cancelled the debt. In the case of a redemption of a debt claim or measure by reason of the debt acquiring the claim in the respect of what of the debt benefit will be amount by which the face value of the claim exceeds expenditure incurred in respect of the redemption of the debt. So sometimes there might be a redemption of the debt, then it results into a measure by reason of debt acquiring the claim. So in the case of a debt to equity conversion, where the creditor or another person that subscribe for or acquires shares in a company did not hold a direct or indirect interest in that company prior to entering into an arrangement, the debt benefit then will be the amount by which the face value of the claim prior to the arrangement exceeds the market value of the shares held or acquired by what? By reasons of result of the what? Of the agreement. So we'll have to go back and say how much was it the person was owed before and how much is the face value now. Then we deal with that difference. That will be the debt benefit. So in the case of a debt to equity conversion, in this case, where the creditor or another company that subscribe for or acquires shares in a company held a direct or indirect interest in that company prior to the arrangements. Now there are two instances. In previous section, we're dealing with company did not have direct interest. In this case, the company had direct interest. The debt benefit will be the amount by which the face value of the claim prior to arrangement exceeds the amount by which market value of the shares held by the creditor or that other company after the arrangement exceeds the market value of the shares held by that person, that company prior to that arrangement. Let's just go back and see the difference. If there's a difference between this section and another one, in this case, they had a direct interest. Okay. And here, benefit. Oh, we're here. Oh, we're here, sorry. Yes, in this slide. So I just want us to go back to see, in the case of a debt to equity conversion, where the creditor or another person that subscribed for acquires shares did not hold a direct or indirect interest in that company prior to entering them, the debt benefit will be the amount of which the face value of the claim prior exceed the market value of the shares held or acquired by reason of what? As a result of that arrangement. Now, this your D state that then the debt benefit will be the amount by which the face value of the claim prior to arrangement exceeds the amount by which the market value of the shares held by the creditor that occurred after they exceeds the market value of the shares held by the person in the company prior to the arrangement. I think they are kind of the same. Yes, no, they are kind of the same. All right. It's just that another one deals with a situation whereby there was a direct, another one there was no direct interest. Section 19 and paragraph 12, capital A. So there is a link here. Section 19 then will apply if a debt-funded expenditure for which a deduction or an allowance was granted under the Act, while paragraph 12A will apply if the debt-funded expenditure for which a deduction was not granted under the Act. Those are two instances, guys, please. Section 19, the debt-funded expenditure for which a deduction or allowance was granted under there was a grant in terms of what of the deduction. There was a deduction or allowance. However, 12A, there was no deduction or any allowance. So paragraph 12A, 12 capital A then will not apply when section 19 applies, unless debt reduced had funded expenditure incurred in acquiring an allowance asset. So let's say, for example, you got a debt, but you use that money to acquire what? An allowance asset, in which event both section 19 and paragraph 12A may apply. For example, Section 19 will apply for trading stock and not paragraph 12A. Then by contrast, then both 1219 and paragraph 12A may apply to a machine used for process of what? Of manufacturing. As you know, there is no allowance. There is no kept allowance. There might be a deduction, but sometimes there might not have been kept allowances. That's your 19. But both sections may also apply. Okay, let's just deal with these sections. See, we've got section 19. So tax deductible expense. So if there's a benefit and then amount need to be recouped under section 19.5. In section 8.4a, then your trade deals with your trading stock benefit amount applied against trading stock, deductions, section 19.3 then also excess of reduction amount, which will be recouped under your 19.4. So if an asset on hand when the debt benefit occurs, let's say we still have this asset on hand when this debt benefit occurs, when we're allowed a deduction, maybe perhaps there's a waiver in that case. The reduction amount then reduces the base cost of an asset. So we'll have to reduce what? The base cost of an asset in terms of what? Your paragraph 12A. So excess amount then will need to be recouped under your 19.6 and also your section 8.4. If the asset disposed of in a prior year where the allowance asset was disposed of in a prior year, debt benefit is the difference between the debt benefit limited to the amount not subject to what? To paragraph 12, which is just actual recoupment in the prior year of assessment. So again, then asset treatment. But your capital asset, then you will have your debt benefit occurs when the asset is still on hand, then reduction then amounts applied to reduce the base cost. That's very important. Then the excess will be lost. If the asset is sold and not on hand, then the difference calculated in capital gain and the actual gain also will be included what? In the year of the debt benefit arise. Okay, these sections then do not apply to any debt owed by a person that is in an that is an heir or legatee or deceased estate, to the extent that the debt is owed to and reduced by the deceased estate, and the amount by which the debt is reduced forms part of the property of the deceased estate for purpose of what? Estate Duty Act. That will be dealt separately. And your paragraph 12A6. So to the extent also that the debt is reduced by way of donations, as defined in your section 55, or deemed donations as 58 applies. This section will not apply. Also, this section will not apply to an employer to the extent that the debt is reduced in circumstances contemplated in paragraph 2H of the 7th schedule, the so-called fringe benefit. And also the debt owing to another company in the same group of companies, provided that the company owing the debt has not traded in the current or previous year of assessment, then this will not apply to an asset subsequently disposed also under the section 42. The exclusion also will not apply to debt incurred by what? The dominant company. The debt reduced then will be reduced by issue of shares by another company, provided this exclusion will not also apply if the debt was incurred or settled when the data was not part of the same group. These sections will not apply. Then in addition, then your 12A will also not apply to any debt owed by a company to another company that forms part of the same group as defined in section 41. Then also to a connected person if the debt is reduced in the course or in anticipated of the liquidation, winding or deregistration or final termination of the existence of the company. The debt benefit and trading stock. So the debt benefit then to fund expenditure. So let's say there was a debt benefit. So you got this loan, then you funded an expenditure. So if the debt funded expenditure other than trading stock or an allowance asset, the reduction must be recouped in terms of what? 9.5. So you'll need to have a recoupment in this case. So you got the debt, we agree, but you use that now to fund trading stock. Okay, that's fine. Now the debt is reduced. What happens? So you'll have to have what? To have your recoupment. That benefit to fund trading stock, that the amount of debt that was used to fund trading stock that is held and not disposed by the taxpayer at the time of the debt reduction, then the reduction amount must be applied to reduce the deduction previously claimed in respect of trading stock. For example, your deduction previously claimed by what? Might have been your section 11A. So the amount then by which the debt reduced exceeds the cost price or the trading cost, you will have to recoup now in terms of what? Section 19. Also through what? Your section 8.4 mechanism. What are the section 19 implications? So this is the debt benefit to fund an allowance asset. One, to the extent that the debt benefit exceeds the base cost of the asset. Let's say now the base cost of the asset is 100,000, but the debt benefit is 150,000. The debt benefit exceeds the reduction in debt. You see that? So it must be recouped in terms of what? Section 96 through the terms of what? Section 8.4 mechanism. You need to recoup in case there is that difference. Your paragraph 12A, capital A. So this paragraph, of course, will deal with the definitions, how it applies and all that, pre-evaluation and also the exclusions. We'll deal with all those things. This is just the summary, guys, but let's just get straight to the paragraph itself. So your A, your 12 capital A, then decision rule. You ask yourself a question, is there a debt benefit? If the answer is yes, then if there is no debt benefit, then this one is excluded. What was the purpose of the debt? To fund an allowance asset of capital asset. So you went on to get the debt to fund an allowance asset. What is an allowance asset? For example, it's yours. It can be a section 11E, it can be a section 12E asset, but you got an allowance to this asset. The implications for debt benefit then from the funding will be the capital asset. Is the capital asset, if the capital asset is on hand, the benefit, the debt benefit, we have to reduce the base cost of that asset. If the base cost of the asset was 100,000, you've got a debt benefit, your debt is reduced by 20,000 rand. That 20,000, we have to reduce what? The base cost of the asset from 100,000 to 80,000. So that you do not get allowances on that difference because you already have a debt benefit. So allowance asset on hand is reduced base cost and excess. If there's any excess, you'll have to recoup it. Creditor's implication. What happens to the creditor? So the capital loss is disregarded in terms of what? Section 56 of HIQ. So unless, of course, there's exceptions which are met, which includes a reduction of base cost, you'll have to reduce the base cost, or a capital gain under 12 capital A4 by the debtor is recognized. So it will have then to be included in gross income or aggregate capital gain or loss of the person acquiring the debt, and the creditor proves to be what? To this case. But it also have to be included on the gross income of the debtor or reduces the assessed loss of the debtor. Then your paragraph 56.1 then will then in this case overrides your para 39. How about unquantifiable amount? Can you have an allowance or a deduction on an amount which you don't know? This section talks about that, talks to that. Section 24, capital M, provides that a taxpayer is deemed not to have acquired or disposed of an asset if their consideration in respect of the asset is not quantifiable. Sometimes we cannot quantify it, we don't know. It is still a work in progress. The consideration then is deemed to have incurred or received in a year in which that becomes what? Quantifiable. Up to that time, you can quantify it. Section 11J. So in respect of the years of assessment then commencing from 1 January, this is not an old section, a new section then is now included in the Income Tax Act. So the allowance can only be claimed if the debt is due to, this is the your debtor's allowance. If the debt is due to the taxpayer and would have been allowed as a deduction under any other provision of the Act. What does this mean? Maybe the debt is due to you, but would have been allowed as deduction. What does it mean? For example, you have been allowed as what? As bad debt. Now, in this case, you've got what? A debtor's allowance. So there are two instances. You apply your section, your IFRS 9, 40% of the loss of the loss allowance relating to the impairment measurement at an amount equal to the lifetime expected credit losses of a debt, other than the lease the least receivable plus. So then you talk about your impairment measurement, but it should relate to the lifetime expected credit losses. You should be given an amount which relate to what the lifetime expected credit losses. Then the portion then of the bad debt written off, reported in the financial statements that did not qualify for Section 11I deductions, then your current and previous year of assessment, but was included in the income of the taxpayer, then is current or previous year of an assessment. So in this case, then also, you'll then also have to apply 25% of IFRS losses allowance related to the impairment of a debt other than the lease receivable or debt already included in the 40% inclusion above. So this is a new act, perhaps the new inclusion to this act. Hello, guys. I don't know what happened. I'm sorry about that. I don't know what happened. So I to restart. I'm sorry about that. Just quickly go to my slide. Not sure it's a network issue. I think it's a network issue because the way I was just cut out, I don't know what happened. All right, guys, let's get on though. I'm sorry about that. Let's just get on where we were. Where were we? Um, okay. Oh, actually, we were done, actually, guys. Okay. See, there was a comment. Just all right, thanks, guys. Thanks very much. Yes. I think, guys, we're actually done because it's just this slide, actually. Because we were in this slide. So we're actually going to go to this slide, then we are done after that, yes. But let's just go through this slide in section 11J. So this section, then they say if the taxpayer does not apply IFRS 9, so IFRS 9 refers to your instruments. What do they call it now? Financial instruments. So if you don't apply this IFRS 9, then the doubtful debt then allowance would be the sum of 40% of the debt in arrears for 120 days or more. So it means then you need to kind of know what's going on. You need to kind of read the scenario and understand what's going on. Is the taxpayer applying IFRS 9 or not? You're asking yourself that question before you actually kind of give your answer. So 25% then of the debt in arrears for 60%, so 60 days or more, but excluding, of course, any debt to which IFRS 9 is applied. And also the taxpayer then can make an application to the commissioner to issue a directive to increase the 40% inclusion to a maximum of 85 with various factors to be considered. But the onus, of course, in that case will be also to the commissioner whether they allow that or not. Yes. All right, guys, that's it. That's it then for today's lecture. Thanks very much, guys, for attending the session. Yes. But then do you have any question, maybe perhaps regarding to what we've done today? All right, I don't see any question. Okay. All right, guys, thanks very much then. Thanks for attending the session. Enjoy your evening. I'm sorry about the hiccup that just happened. I mean, immediately before, perhaps just now before we could be done, but it's fine. At least we're able to get back to the lecture and carry on. Nice. All right, guys, thanks very much then. Bye. See you next time. Next week, perhaps.
Thank you. Bye.